Hi, welcome. My name is Michiel van den Broek. Since 2005, I have trained thousands of participants working in the financial sector. My contribution is to make complex finance accessible to my course participants. Finance is not rocket science. This short video introduces you to some basic interest calculations on the money markets, the financial market where short-term investments and loans are concluded. To participate, you only need basic skills in mathematics. You will learn how to calculate a simple money market interest amount, also known as a coupon. Next, you will be introduced to calculate a rate of return and how to compare yields based on different day count conventions. Finally, this session will focus on some other details, such as the end-of-month convention, regular periods, and how to calculate the yield for a broken period. Don't hesitate, it is not rocket science. On the financial money markets, short-term cash investments and loans are concluded. Although the maturity of these transactions in practice can be longer, in this session it is assumed that the period is maximized to 1 year. The interest rate percentages for these transactions, that is also known as the yield, is always quoted on an annual basis. Let's start with a simple example how to calculate an interest amount, often also named a coupon. Several variables are needed to calculate the interest amount, such as the day count convention, the year basis, and the coupon frequency. For this session, multiple coupons are not included, so the coupon frequency for all calculations is 1. In this simple example, a nominal amount of $100 million is invested at 4%. If the investment is for 1 year, the coupon amount equals $4 million. But if the investment period is 6 months, the coupon equals $4 million multiplied with 6 months and divided by 12 months, giving a coupon of $2 million. There is a formula to calculate the coupon interest amount. Next example will illustrate the use of this formula to calculate a coupon interest amount. In this coupon interest amount calculation formula, the nominal investment or loan amount is multiplied with a day count convention and the annual yield percentage. The annual yield percentage is represented by the Y in the formula. The day count convention is D divided by B. The D represents the number of days of the transaction, also mentioned the coupon period. Often, D is the actual number of days, but other number of day assumptions can be possible. The money market standard method to determine the number of days in the coupon period is to exclude the maturity date, but to include the start date. The B represents the number of days in the year basis. Depending on the currency, the money market standard is to set B on 360 days or 365 days. The 360-year basis is used for money market coupon amount interest calculations such as Euro, US dollar, Swiss franc, and Japanese yen. The day count convention for these currencies is the actual days in the coupon period divided by 360 days for the year basis. However, the 365-year basis is used for money market coupon amount interest calculations such as British pounds, Australian dollars, Singapore dollars, Canadian dollars, and Hong Kong dollars. The day count convention for these currencies is the actual days in the coupon period divided by 365 days for the year basis. Next example illustrates the use of this formula to calculate a coupon interest amount. In this example, a nominal amount of $20 million is invested for a yield of 3.2% on the 4th of April and matures the 23rd of May in the same year. In order to calculate the interest amount, first the number of days for the coupon period has to be determined. From 4 to the 30th of April, the number of days is 27 because the 4th of April is included. From the 1st to the 23rd of May, the number of days is 22 because the last day, May 23rd, is excluded. The total number of days in the coupon period, shown as D in the formula, is therefore 27 plus 22 days, so in total 49 days. The year basis, the B in the formula, is 360 days, because this is an US dollar money market investment. Using the formula, the coupon interest amount equals $20 million, multiplied with 3.2%, multiplied by 49 days divided by 360 days, resulting in $87,111.11. Another use of this formula is not to calculate the coupon interest amount, but to calculate a yield. The formula to calculate the coupon interest amount can also be used to calculate the interest rate percentage, the yield. In finance, this interest rate percentage is also known as the rate of return, or the rate of investment. The rate of return is represented by the Y in the formula. Please remember that all periodical interest rates are annualized. To illustrate a rate of return percentage calculation using the rate of return formula, in this example, a nominal of £5 million is invested for a coupon period of 45 days. The D in the formula. It is assumed that the investor receives £5,020,342 after 45 days. The coupon amount of £20,342 is calculated by subtracting the investment of £5 million from the maturity amount of £5,020,342. The year basis, the B in the formula, is 365 days, because this is a British pounds money market calculation. To calculate the annualized yield, the coupon amount of £20,342 has to be multiplied with the year basis of 365 days and divided by the coupon period of 45 days. Using the formula to calculate the annualized yield for an investment of £5 million, this results in a rate of return of 3.3%. Let's continue by exploring how yields can be compared if they are based on different day count conventions. In financial contracts, other day count conventions can be agreed to calculate the coupon amount. For instance, another often used day count convention is bond basis, that is represented as 30 divided by 360. This implies that D is based on 30 days per month and not the actual days in the calendar month. To calculate a year coupon, D will be 360 days. The year basis represented by B is 360 days. Of course, the coupon amount will vary for different day count conventions. For instance, if an investor wants to invest €100 million for a year and has received offers from Bank A and Bank B, Bank A quotes 5% for a 3,360 bond basis, and Bank B quotes 5% on actual 360 basis. The coupon amount for the bond-based offer will be €5 million for Bank A. Because Bank B pays interest based on the actual number of days, the coupon amount for a regular year will be €5,069,444. An investor can only compare different yields per coupon period if they are based at the same day count convention. It is possible to compare quotes based on different day count conventions by applying a conversion formula. As an example to compare yields that are based on different day count conventions, following formulas can be used. To convert an actual 360-based yield A to a bond-based yield B, the yield for A has been multiplied with 360 and divided by 365. To convert a bond-based 3,360 yield B to an actual 360-based yield A, the yield for B has been multiplied with 365 and divided by 360. If it concerns a leap year, the 365 has to be 366 days. Following example illustrates a conversion of a 3,360 bond-based yield of 5% to an actual 360 basis. Using the conversion formula for a regular year, the 3,360 basis 5% yield has to be multiplied with 365 and divided by 360, resulting in 5.069444%. This means that a 3,360 yield of 5.069444% generates the same coupon amount as an actual 360 yield for a regular year. Please be aware that the counterparty risk also has to be taken into account to compare investment decisions. Beside the day count conventions, also the number of days for a specific coupon period have to be set. To make interest rate calculations for financial contracts, the start and maturity dates have to be specified. Both the start and end date should be a business day. A business day can only be a day that the central bank's payment system is operational. Therefore, weekend days are not possible. But also bank holidays are excluded because central banks will be closed. Since bank holidays can vary per country, the contract period for the money market financial contract can differ per currency. For the Euro money market's business days, the European Central Bank payment system needs to be operational. For US dollars, it is the Federal Reserve, and for British pounds, it is the Bank of England. The standard terms for financial transactions are a whole number of weeks or months, starting from the spot date. Normally, the spot date is 2 business days from the contract date, but sometimes different start days can be used. These periods from the start date are referred to as regular dates, regular periods, or fixed dates. For example, if the contract date is Monday the 29th of January 2016 and the spot date is Wednesday the 2nd of February 2016, the end dates for a regular period of 1 week is Wednesday the 9th of February 2016. The end date for a regular period of 1 month is Wednesday the 2nd of May 2016. For 6 months, it is Tuesday the 2nd of August 2016. If the maturity date of a regular period is not a business day, it is impossible to make a payment transfer, and the end date has to be changed. To change a regular date, because the maturity date is not a business day, the used conventions are following and modified following. With the following convention, the maturity date will always be postponed to the next possible business day. The following convention is normally used for contracts with a term shorter than 1 month. For example, if a week regular period ends on a bank holiday that is a Monday, this regular period maturity date will be Tuesday, under the condition this is a business day. For contracts of 1 month and longer, the modified following convention is used. Applying the modified following convention, the maturity date is set on the next business day, except when the adjusted maturity date would then be in the next month. If this would be the case, the maturity date is set on the previous business day to avoid a change to the next month. If, for example, a 2-month regular period ends on the last day of a calendar month that is a weekend Saturday, then the modified following convention is applied, changing the end date to the previous business Friday of that calendar month, instead of the next business Monday in the following month. If the start date of a financial money market transaction is the last business day of a month, the month ultimo, the usance is to apply the end of month convention. If the end of month convention is applied, all regular maturity month dates will also be set on a month ultimo date. Additionally, the modified following convention is applied. For example, if the financial contract date is Friday the 27th of March of a regular year, normally the start date of this contract will be the spot date, so 2 business days later. Assuming that there are no holidays, and since the weekend days are not business days, the starting date of the contract is Tuesday the 31st of March, the month ultimo. Since the start date is the month ultimo, the end of month convention applies. Let's assume that the 1-month regular period would end on Saturday the 30th of April. A weekend day is not a business day, and because the modified following convention is applied, in this example, the 1-month regular maturity date would be changed to Friday the 29th of April and not to Monday the 2nd of May. Next, you will learn about another subject, the yield for a broken period. Money market traders are key players in the supply and demand of short-term funds on the financial markets. These traders inform each other and clients by quoting bid and offer yield for regular periods. Beside yields for regular periods, transactions can also be done for a non-regular period, also defined as broken period. The yields for regular periods are used to calculate yields of broken period. For a broken yield calculation, following formula can be used. In this formula, YB is the broken period yield that will be calculated. YS is the yield for the longest possible regular period before the broken period. YL is the yield for the adjacent period after the longest possible regular period. The day count fraction is calculated by dividing D short by D long. D short is the difference between the broken period days and the longest regular period before the broken period. D long is the difference between the total days and the longest regular period before the broken period. The following example illustrates how to apply this formula to calculate a broken money market yield based on regular period yields. Following data are used in this example to illustrate the calculation of a broken period yield. Suppose the 1-month regular period is 30 days, the 2-month regular period is 60 days, and the 3-month regular period is 90 days. Further, the corresponding yields for the regular periods are 2.57% for the 1 month, 2.97% for the 2 months, and 3.04% for the 3 months. In this example, a yield for an 80-day broken period will be calculated. The first step is to determine the day count fraction, D short divided by D long. D short is the broken period number of 80 days, minus the longest possible regular period of 60 days for the 2-month period. Therefore, D short is 80 minus 60, so 20 days. In this example, D long is the 3-month regular period of 90 days, minus the 60 days of the regular 2-month period. Therefore, D long is 90 minus 60, so 30 days. The day count fraction is D short divided by D long, so 20 divided by 30. The second step is to calculate the difference between Y long and Y short. Y long is the yield for the adjacent period after the longest regular period, so the 3.04% for 3 months. Y short is the yield for the longest possible regular period in the broken period, which is the 60 days 2-month regular period, with a yield of 2.97%. The difference of 0.07% is calculated by subtracting 2.96% for Y short from the 3.04% for Y long. The third step is to multiply the yield difference of step 2 with the day count fraction of step 1 with, so 0.07% multiplied with 20 and divided by 30 equal to 0.047%. Finally, the broken period yield can be determined by adding 0.047% of step 3 to Y short of 2.97%, resulting in an 80 days broken period yield of 3.017%. For now, this example finishes this part about basic interest rate calculations. There is much more to learn about interest rates and calculations, such as implied forward rates, present and future value calculations, discounting, true yields versus pure discounts, and compounding. If you want to know more about my expertise and financial training programs, you are invited to visit my internet site. Thank you for your participation and good luck.